Gold is having a bit of a moment, as they say. Thanks to a global trade war, macroeconomic uncertainty, and record central bank purchases in recent years, demand has been skyrocketing, and the price of gold reached a new all-time high in the spring of 2025. In late 2022, you could buy an ounce of gold for about $1,600. As of July 3rd, 2025, it's more than double that. So, with that eye-popping jump in price, it's no wonder many people are probably asking, is it a good idea to invest in gold? There are many reasons why investors may want to hold gold in their portfolios. For some, it provides them diversification. The market forces that affect the price of gold are generally different than what affects other assets, like bonds and large cap stocks. For example, during times of rising inflation, geopolitical uncertainty, and market downturns, gold has historically performed better than equities. So, while one portion of their portfolio might be suffering, it could be partly offset by the perceived protection that gold provides. Take the 2008 financial crisis, for example. The price of gold that year rose by almost 3.5%. The S&P 500, however, it fell 37%. Or there was the popping of the dot-com bubble between 2001 and 2002. In those 2 years, gold prices rose about 1.5% and 24% respectively. Compare that to equities falling 12% and 22%. Gold is also often sought after by investors because it has historically held its value over time. The reason is simple: it's scarce. According to the World Gold Council, 216,000 metric tons of gold have ever been mined. That's throughout all of human history. And it only increased by about 3,300 tons in 2024, according to the USGS. That might sound like a lot, but compared to the production of other minerals, it's practically nothing. Unlike stocks, bonds, or cash, we can't make more of it by snapping our fingers. And one more reason investors might look for gold: it can be a hedge against inflation. Gold as a commodity is priced in US dollars. As inflation rises, the value of a dollar falls. It doesn't buy as much as it used to. Therefore, it takes more dollars to buy something. So in this case, it takes more dollars to buy the same amount of gold. And as the price goes up, investors benefit. So that's the why. Now, let's look at the how. If you're interested in adding gold to your investment mix, there are several ways you can go about it. We'll explore 3 of the most common: buying physical gold, gold ETFs, and buying the stocks of gold mining companies. Let's start with owning physical gold. And what that means is gold that you can hold in your hands. Physical gold can be bought from individuals, jewelers, gold dealers, and bank branches. It comes in lots of forms, such as coins, bars, certificates, and jewelry. But there's the risk of theft or loss, and you might have to consider spending money on insurance to protect your asset. Also, compared to financial assets like stocks and bonds, gold doesn't generate revenue or produce income. Rather, it's widely considered a store of value. Finally, any profit may only come if you sell it. And if you try to do that, you might not get the full value you're looking for. Now, let's look at gold ETFs. Not only does the price of the ETF track the price of gold, giving you the same benefits as physical gold, it's also highly liquid, meaning it's easy to sell, much more so than physical gold. However, all gold ETFs have fees attached to them called management expense ratio. It's what the ETF issuer charges to cover their costs, and over the long term, it will impact overall returns. Then there's gold mining stocks. These companies directly benefit from a rising price of gold, as they can sell their products for more. A rising gold price, therefore, can directly benefit shareholders. And like gold ETFs, gold company stocks are also usually highly liquid. Plus, many of the largest gold mining companies in the world also pay dividends, offering passive income that physical gold and gold ETFs do not. However, owning gold mining stocks open investors up to other risks. For example, for many of the world's largest gold producers, gold might only be a small part of their business. So, while gold prices could be heading up, profits could actually fall if the other areas of their business are suffering. Also, gold companies have to deal with geopolitical risk. And like any company, a gold miner might be negatively impacted by poor management, taxes, tariffs, and government regulations that could limit profitability. Next, there are some overall considerations about investing in gold, regardless of how you do it. First, as we discussed earlier, gold is priced in US dollars. That means a Canadian investor may want to consider currency fluctuations. For example, let's say that an ounce of gold is 3,300 US dollars. An investor would pay 5,500 Canadian for that ounce if the loonie was at 60 cents US, but only 4,400 if our dollar was at 75 cents US. Second, it's also worth considering that an investment in gold could underperform against other assets. While it serves as a useful hedge during specific conditions like high inflation or market uncertainty, it may underperform other assets during periods of stability and growth. Over the past 30 years, the S&P 500 has risen more than 1,200%. Gold, meanwhile, is up by 775%. If that was a lifetime of investing, it would represent a significantly lower nest egg at retirement, for example. This doesn't mean there isn't room in a portfolio for gold, though. Rather, investors need to consider a trade-off between the safety gold has historically provided against the potential for lower returns over the long run. This brings us to an important question. How much gold should you as an investor hold? Unfortunately, there's no easy answer. While opinions range between 2 to 15% or even higher, investors may want to consider all factors mentioned earlier, as well as their own personal situation. If you're interested in investing in gold, call a TD Direct Investing representative for more information on physical gold and gold certificates. And if you want to learn more about gold companies and ETFs, check the research tab in your web broker account. Thanks for watching.
Have more questions? Check out the links to the right and in the description below.